Hello and welcome to tradingfloor.com. Well, we're in interesting times at the moment with the Fed pumping in $600 billion into their economy. We've got the G20 summit coming up, and we're also in the middle of a currency war, and how that's affecting commodity markets. We'll be talking to Ulla Hansen, Senior Manager of Commodities here at Saxo Bank. Okay, so we're a week into the QE2 $600 billion package. We've got the G20 summit coming up. Really interesting times for commodities. Can you explain this rally that we're seeing and how it's going to continue?
Yeah, we've seen some dramatic rises since the quantitative easing was announced last week. Basically, the market has continued to go high on the trend that we've seen since August, more or less. And we can say actually they're kind of riding the quantitative easing wave. It's a bit of a surf at the moment, but there might be bumpy waves coming towards us. It's been interesting to watch the last couple of days that bond yields, the very yields that the US Fed is actually trying to keep low, has started to rise the last couple of days. The 10-year area yesterday we had a bond auction which went well, but the market subsequently sold off. So there's a little bit of worry now that if these bonds are not holding at these levels, then we start to see some profit taking there. That could spread to the wider market. Obviously, the central bank liquidity has really turbocharged energy and metals as of late. So really, it is very important now going forward that we continue to keep an eye on the dollar, and we also keep an eye on the bond market, because that's really the essence of the whole quantitative easing exercise.
And we're seeing some rising prices in the commodities. What's the flow-on effect that this is going to have on the economies?
Well, the risk is obviously that initially that there could be some inflationary pressures. That to a certain extent is a good thing as long as it stays under control. But it could have a more adverse impact on growth if these rises continue, especially agriculturals, because they're now obviously starting to have an impact in the shops around the world, and that is something really worth to keep an eye on. And I think if we just look at the commodities this week, how we've been performing, and if we turn to the screen here, the CRB, the overall index, is up nearly 5%, and as we see, there's really everything is in plus apart from this corn, which is small down in a week. But the big moves again is cotton, which is continuing to make new records. Situation in China and Texas where they're worried about supplies. Coffee's up 11, but down here silver's up 13.5. Much higher than the gold, which is only up 5, but generally strong rises across the board over the past week.
So with movement in the dollar, what kind of indicators should we be looking out for?
Yeah, but the dollar has strengthened a little bit since the easing on last week. So if we just look at the actual euro dollar, we've seen this big rally we've seen back since June. This was a spike we had last week after the Fed announcement, and since then we actually come back down again into this range below 140, and the market's now looking for the 137 area to hold. And if that for any reason should give way, there could be some additional profit taking coming in and further dollar strength, and that will have could have an adverse impact on commodities in general.
So we're seeing a bit of support for crude coming up. Can you give us a bit of insights behind this?
Yeah, the energy sector has actually come back to life now after the quantitative easing last week. Also with the evidence that there might be reductions in the inventories in the US coming through over the next few weeks here. That's been supporting the market. So we're holding above 85. 90 is obviously a big psychological level now. We so far failed really to break through the 87 level, which also corresponds to the high levels we saw back in June. If you just look at the chart here, we see this recent rally we had since the August low back in the low 70s, and currently when we broke this above this the 84 area on the December contract, we've moved into the new territory here, but we're still playing with the same levels that we saw back in the spring. So the 84 to 85 area now has to hold for this market to continue up towards $90. It's worth pointing out as well that the speculative long, which is measured by positions held by hedge funds and commodity advisors and money managers, is now at a new record high, higher than when we reached those levels back in April, June. So they obviously believe that the market is going to move higher from here, and as long as we stay above 84, the trend is pointing higher. But it's worth keeping an eye on those levels, because there could be some long liquidation on the break below.
So you mentioned a bit earlier regarding the inventories. What are they looking like at the moment?
Well, we got the weekly inventories from the DOE out this afternoon, and we're actually looking for an increase in crude of 1,500 or 1.5 million barrels, while gasoline and distillates are both looking to draw. So again, it's interesting to watch, because fundamentally that is really, apart from the weaker dollar, one of the drivers as of late, that the market expects that these inventories are going to draw back to more to average levels. So worth keeping an eye on.
And so precious metals, seeing a bit of volatility there of late. What's behind this?
As I showed on the weekly performance just before, the performance we've seen on silver this week is just phenomenal, up more than 15% and nearly outperforming gold by 10%. But this vertical ascent came to an abrupt halt yesterday, and if we just look at the chart here, we can see how this move has been going on, unfolding since we moved from $18 all the way up to $28. But yesterday, when we reached these levels, we had a snap $3 sell-off, and the market's a little bit more balanced now, and I was a little bit worried that that could be a repeat. The reason behind the move yesterday was the margin requirements on leverage positions in CME in the US was raised by 30%. At the same time, we had the bond yields rising, and we had the dollar strengthening a bit. So there was some selling coming into to gold and silver yesterday. It's worth pointing out once again that on these sell-offs we've seen so far, we saw one as well last week just before the announcement of the quantitative easing. Buyers are still waiting in the wings, so every time we see these major sell-offs, the buyers are coming back fairly quickly. That obviously needs to be maintained for this market to progress even further, but for now that 137 level mentioned before in the euro dollar is worth keeping an eye on, because a further dollar strength could have an adverse impact, at least short term, on these markets. So
we're still potentially looking at $1,500 dollar mark for gold by the end of the year? Is something we're talking about?
This year is probably a little bit too soon, but 1450 could still be in the cards. But I think because the market, the moves has almost been vertically, there is a risk that we will have we'll have some kind of a pause sooner or later, and the outside markets, as I mentioned before, how the yields are developing on bonds and how the dollar's faring, that's really worth keeping an eye on.
Thanks, Ola. And don't forget, you can check tradingfloor.com for the latest in global markets, and you can also follow us on Twitter at tradingfloor.com. Thank you, and we'll see you next time.